Welcome back, everyone. It's a real pleasure to welcome all of you to this live session at Equity Income Summit 2013. We have a real treat ahead, and we're very grateful that we were able to arrange this Q&A session with truly one of the investing greats. Oliver will introduce our instructor in just a moment. Before he does that, I just want to remind everyone that the session is being recorded and will be available in our online conference area within 24 hours. Feel free to type your questions into the online interface at any time. We've also gotten quite a few questions in advance of the session, so we'll jump right in after Oliver introduces Howard. Oliver, please go ahead.
Thank you, John, and especially for allowing me to introduce Howard Marks, who of course is one of the world's most successful investors and also an incredibly generous instructor to all of us on the art of investing. I'm sure I speak for all of us at this conference when I say that we are very much indebted to Howard for sharing his wisdom so abundantly over the years through his investment memos and his recent book, The Most Important Thing, which I had the pleasure of discussing with Howard in London, and we have a video recording available for you online at valueconferences.com and the Manual of Ideas. Howard Marks is, of course, chairman of Oaktree Capital Management, which he co-founded in 1995. The majority of Oaktree's more than $75 billion of assets are in corporate and distressed debt investments, and we look forward to learning from Howard how income-oriented strategies can be employed successfully across the various asset classes in this low-return environment. Before going to the audience questions queue, I'd just like to ask you, Howard, about your February investment memo, in which you stated that in this type of environment, superior returns are more likely to be earned through minimizing mistakes than through stretching for yield. Perhaps a fitting first question then is, what are some of these mistakes investors are making, and what is your advice on how to minimize them?
Oliver, it's a very interesting question. I think that, it fits my personality to think that for me, the route to success is primarily through the minimization of mistakes. I try to project myself forward 3 or 5 years, look back and say, will I be glad I did X or Y? If I'm not, what went wrong? And so forth. So kind of jumping forward and looking back. And to me, the most important single question at a point in time with regard to strategy, I'm not talking about tactics, I'm not talking about what's going to go up tomorrow, I'm not talking about eternity, but for the middle term, let's say 3 to 5 years, I think the most important thing at a given point in time is whether how you're balancing offense and defense. And if you have offense and the markets turn good, you make a lot of money. If you have defense and the markets turn bad, you avoid losing a lot of money. But of course, the reverse is true as well. So it's very important to have the appropriate mix of offense and defense at a given point in time. Basically speaking, we want to have a lot of offense when prices are low, psychology is depressed, and the outlook is bad to most people, but we don't think it's so bad. We want to have defense when prices are high, psychology is buoyant, and everybody sees a brilliant future, and we don't think the future may live up. So where are we today? Unfortunately, I think today we're in the middle, and it's more fun and it's more easier to know what to do when we're at either extreme. We know we want to sell at the highs. We know we want to buy at the lows. Well, what do you do in the middle? I think that's about where we are today, which means that we have to balance offense and defense. I don't think that prices are so low or psychology is so depressed or the outlook is so good that it's time to be aggressive. But I also don't think the prices are so high or psychology is so buoyant or the outlook is so bad that it's time to be defensive. And the other thing, of course, today is that if you're entirely defensive, then you have to go into things that yield pennies on the dollar or fractions of pennies, perhaps. So, you know, one of the things I said in the book is that when there's nothing clever to do, the mistake is in trying to be clever. I don't think that this is a time when there are compelling, clever things to do, big picture-wise. You know, hopefully we can always find some bargains, but of course in a difficult market when everybody's combing markets and willing to spend money, the bargains tend to be fewer and further between.
Perhaps going back to basics, how do you define stretching for yield? How do you recognize it, and how do you control it?
Well, today's markets give the fixed income investor, which Oaktree largely is, a very, very good lesson in answering your question, Oliver. I would define reaching for yield or stretching for return as doing things that go beyond what you normally would do, that are riskier than what you would normally do, because you can't get the kinds of returns that you want and traditionally have gotten in doing the things that you traditionally have done, and especially in doing the things that are of the riskiness that you have traditionally borne. So what it means for a fixed income investor, everything is, by the way, everything is a little clear cut in fixed income because fixed income is so mathematical. But the lessons, the themes, are the same for investors in all asset classes. But anyway, reaching for yield in fixed income means moving out the risk curve, investing in lower quality assets, riskier assets, because you can't get the return you want in assets of the risk you normally have borne. If you go back to September '07, when the Fed started cutting rates to deal with first the subprime crisis and then the global financial crisis, you know, why did the Fed do it? Well, number one, we know they did it to stimulate the economy, and lower rates make everybody more eager to buy and make it cheaper to carry investments. The other reason is because they wanted to restore the capital base and viability of the financial institutions. And you know, if you lend the bank money at 0, which they can loan out at 5, it's just like if you wrote them a check for 5. So those two motivations were obvious. But what I think people didn't catch on to as much, I didn't catch on to as much, is that if you eliminate the return on Treasury bills, you take all the Treasury bill investors, or most of them, and you force them at the risk curve where they have to do more aggressive things. And so the elimination of return on risk-free assets, low-risk assets, basically restored the interest in risk-bearing. One of the big problems in a crisis or crash is that everybody says, that's it, I'm never going to take any risk again, I'm done with risk-taking, and the markets freeze up, and people can't refinance, for example. Well, by forcing people to take risk, they caused the financial markets to reopen. And you know, most people did not think that the high-yield bond market and the leveraged loan market and the real estate market, the MBS market, and maybe the equity markets would be back as strongly as they were by late '09 and 2010. And I attribute a lot of it to what the government did. Anyway, but my point is, I'm sorry, I always digress, but the point is that eliminating the return on T-bills made the T-bill investor or the high-grade bond investor go into high-yield bonds. The high-yield bond investor used to get 12 and now can get 6, he may want to go further out the risk curve to try to get back to 12. But it's very dangerous because you must be aware of the incremental risk you're taking, and it takes you into waters that you may not be familiar with and expert in.
I want to turn it at this point to John for additional questions that have come in advance, as well as questions that are coming in as we speak. John?
Thank you, Oliver. Howard, if I'm not mistaken, you've essentially said we're sort of in the middle innings here in terms of the market temperature as you feel. There's a question that essentially says, Prem Watsa and Warren Buffett are taking apparently very different stances. Watsa is hedging his equity investments and is concerned about the macro, while Buffett and Berkshire seem to have a diametrically opposite view with more of a positive outlook. Since you already told us where you stand on the temperature of the market, perhaps you could help us understand how two so smart investors can come to such different conclusions.
I'm sorry, who's the bear you're talking about?
The bear is Prem Watsa of Fairfax Financial in Canada.
Ah, sure. Well, you know, it's never easy to figure out exactly where we are. I think that if I were pressed, you know, this business about what inning are we in has become the new rage in the last 5 or 6 years, and it's hard to say, especially given the fact that there are different markets, different countries, different investment categories, different risk categories, et cetera. But I would say that whereas we are in the middle innings, we're not in the middle of the middle innings. We may be in the advanced stages of the middle innings. And basically, the concern is that this low rate environment has forced people to engage in pro-risk behavior. We see it, for example, in the high yield bond market where you can issue covenant-light bonds, you can issue triple Cs, you can issue bonds to raise money to give it out to the shareholders, and so forth. Now, you asked about this dichotomy. I don't know so much about their thinking, but I think that, number one, Buffett, of course, takes the longest view because, number one, he's the largest, and number two, his assets are so illiquid when you own whole companies. So, you know, what does it mean to take a long-term view? What it primarily means is we have long-term trends, secular trends. We have modest cycles around the trends when measured in decades or longer. And then we have cycles around the short-term cycles around the long-term trend. And taking a long-term view means ignoring the shorter-term fluctuations. And I think that probably Buffett is saying that he's willing to ignore the short-term fluctuations. And I think part of it is because he has to, being as big and as locked in as he is. And part of it is his nature in that he's very happy owning good companies at fair prices that he thinks have moats and good management, good people, and less concerned about profiting in the short term, where the other Watts may be more concerned about what the next year or two holds. You know, going back to Buffett, you know, he has, my favorite quote of his is that the less prudence with which others conduct their affairs, the greater prudence with which we must conduct our own affairs. Watts is right. People are behaving less prudent than they did a year and a half ago, or 3 years ago, or 4 years ago. And so I think that, you know, I'm willing to say that we're in the 6th inning, so that means we should be more prudent, more cautious than we were in the 4th inning or the 2nd inning. We're not in oversold territory, we may not even be at exactly fair prices. We may be at a little on the optimistic side of fair because of the force of low rates.
How has your investment approach and the related opportunity set changed over the last 3 decades as the 30-year Treasury rate declined from double-digit rates in the early 1980s to less than 4% recently? What are some of the key lessons for investors who are worried about a rise in interest rates?
I think the biggest single change in the investment markets in the last 3 decades, and you know I started in this business 45 years ago and started managing money 35 years ago. The biggest single change over that period, I think, is that at the beginning of that period there were whole asset classes that people either didn't know about or didn't consider seemly or didn't consider proper, or even asset classes that were against the rules. Junk bonds are an example. And you know, when there are a whole bunch of people who say, I do A, B, and C, but I never would do E, then probably you'll find the bargains in E. And in my career, I was able to start in high-yield bonds and convertibles in ’78, and then branch into distressed debt in '88, and branch into distressed mortgages in '94, and then move over to Europe in '99, which was behind the U.S., and so forth. And we've constantly, my partners and I have constantly been branching out into new things that we thought were not fully understood. And by the way, that's good code for not fully efficient. Today, to put it in short, everybody's willing to do everything. There are no asset classes that most people will refuse to go into regardless of return, and so it's just that much harder to find the free lunch. Let's see, Michael Mauboussin of Credit Suisse recently put out an interesting paper in which he said, he said when he was young he was trying to get good at poker, and he was studying and he's working on other players' tells and studying the probabilities of catching the card you need with a certain hand. And he had an uncle who was an experienced poker player who said, that business about trying to be a better poker player is silly. What you should do is spend your time trying to find easier games. And 30 or 35 years ago, or 25 years ago, there were a lot of easier games. And now we have something called the Internet, which spreads the information. We have most people who are willing to play in any game, and it's easier to find them. And so the easy games have become less easy. That's the biggest single change. And when markets become efficient, we should acknowledge it. We ignore reality at our own peril. Now, then what about the decline in rates? And since I am a conservative investor and I have a lot of my money at Oaktree, the money that I have outside of Oaktree, I don't believe that every dollar has to be fully employed every minute. I've always had money in treasuries because I like the liquidity, I like the comfort that comes from having a bunch of money in treasuries. And I had a lot of treasuries heading into the crisis in 05, 06, 07, more than ever. And I think that the average yield on my treasury portfolio, 3, 4, 5, 6 year treasuries, I had what was called the ladder. You own 1, 2, 3, 4, 5, 6 years. When the 1 year matures, you put it at the end of the line, you buy a 6 year, and you always have a portfolio which is spread out and something coming due to provide liquidity and to reinvest in contemporary circumstances and yields. And I think that the average yield on that portfolio of intermediate-term Treasury notes was about 6.5%. In other words, you could get a good yield and safety at the same time. And today, to put it in short, you can get a good yield or safety. You can't. The the intermediate term treasuries are now 1-something% yield, not 6.5. So if you want safety, you get 1.5%. And if you want yield, then you can't have it with the safety of treasuries or with a high degree of safety at all. That's a big difference, and it makes investing harder, and it really puts, I think it encourages risk-taking because people want the old 6, but when other people are moving out the risk curve and taking more risk, then the key for us is to remember to stress caution, as Buffett says. And my mantra for today is move forward, but with caution. Things aren't so bad that we refuse to move forward, but we must remember to include caution. What else?
To use the title of your book, what is the most important thing for successful income-oriented investing?
Well, of course, you're playing with the title, because I wrote the book and I named it The Most Important Thing because there is no most important thing in investing. There are 20 chapters, and each one starts off, the most important thing is, and then it's a different thing. Value to price, psychology, risk, contrarian, countercyclical, defensive investing, etc. In general, there is no one thing. All of the elements that I discuss in the book are essential elements in putting together a solid foundation for investing. But you say for yield, I take it you mean for fixed income investors. And fixed income investing is easier than equities because the returns are fixed on the upside. There are not varying degrees of success. If you're successful, you get the promised return. It's very, very hard to consistently make more than the promised yield to maturity on a fixed income portfolio because, once in a while you can do it through an upgrade or a takeover and improve quality, but for the most part, a bond is issued at par, it's going to be repaid at par, and if you buy it at today's price, given today's stated yield to maturity, you're going to get par at maturity and you're going to earn the stated yield. There's a vagary with regard to reinvestment rates, but I'll leave that out for now. So what is the most important thing? The most important thing then is that if there are no different degrees of success, there are many different degrees of failure. And the most important thing is to avoid failure. Oaktree's motto is that if we avoid the losers, the winners take care of themselves. That is today, if we can put together a portfolio of 100 bonds, none of which default, and that's very hard, and we haven't always done it. I don't want to give the impression that we have, but if very few of them default, then the rest will give you the return you wanted, and once in a while you'll have a favorable surprise, an upgrade or a takeover, and you can do a little better. But the key element is that you avoid the losers. If you go back to the 1940 edition of Graham and Dodd, which was reissued about 5 years ago, and I wrote the new section on fixed income, you'll see that I found when I had to go back and read it for the first time since college that Graham and Dodd call fixed income investing a negative art. What they mean is that you add to your performance not through what you include, but through what you exclude, and that's the exclusion of the bonds that don't pay. Well, all the 8% bonds that pay will essentially pay 8%. So it doesn't matter which of the 8% bonds you buy, which pay. It matters whether you exclude the 8% bonds that don't pay. Negative art. That's the most important thing, I think, in fixed income.
In equity valuation models, how should investors adjust for the historically low level of interest rates?
Well, that's an interesting question. It's a bit of a trap. And I wrote a memo, I think it was in March. Oliver, you probably know better than me. But it was called The Outlook for Equities, I think. And, by the way, all my memos are available on the Oaktree Capital website in the upper right-hand corner where it says memos from the chairman. And so in the memo on equities, I enumerated what I thought were the pros and the cons. And as I recall, there were about 6 pros and 8 cons. So somewhat, numerically, somewhat more cons than pros. I'm not going to tell you how I came out because then you won't buy the memo. By the way, the memo's free. But I talked about this business of interest rates because obviously when interest rates are low and yields are low, that means that the rates on competing investments, the potential from competing investments becomes more valuable. If a stock has a yield of 3%, when bond rates are 8, that's not impressive. When bond rates are 1, that's very impressive, and people might flock to it. So you know, the lower the bond yields are, the more attractive a given stock is at a given price. And that means that with today's rates close to record lows, and of course they were at record lows prior to 10 weeks ago, stocks are more attractive than they otherwise would be considered at today's PE ratios. On the other hand, there's always another hand, and that's what makes investing interesting. On the other hand, rates can go up. And if you buy stocks today and one of the big props under your thinking is that rates are so low, that means that if rates rise, that prop will disappear. So low rates are a reason why stocks are attractive today, but they're also subject to abating as an attractive force.
Well, Howard, you've promised us 30 minutes. We have about 3 minutes left. Perhaps the last question, what should equity investors learn from fixed income investors that can help them improve their equity investment process?
Couple of things. I was an equity analyst from 1968 to 78. I was the Citibank Director of Research before I went into portfolio management on the bond side. And so the reason that high yield bond investing was good for me is because they both dealt with the uncertain future of companies, equities and high yield bonds. On the other hand, I described the math of bonds. Bonds can only produce disappointment. The upside of it is not variable, only the downside. So I think that what the equity investor can learn from the bond investor is to worry about what can go wrong. I think most equity investors are optimistic by temperament, and they tend to think, well, how much money can I make if everything goes right? The bond investor thinks only about what can go wrong. I think that the fusion of the two is an improvement, and I think that the fixed income, that the equity investor should think about, well, yeah, but what can, I know the bull case, but what can go wrong, and how would it affect me? And the other thing is that you know, the differentiation in portfolios in fixed income is purely through the exclusion of losers, even though it's not true in equities as well. You also want to find winners. I think it's very important to bear in mind the importance of losers and the importance of excluding them from your portfolio. So hopefully the two can work together.